Investors are upset with the YieldMax ETFs. We have seen some terrible performance over the last couple months from some of their top ETFs, including MSTY and ULTY. So I had Michael Coe from the YieldMax team back on the channel to ask the hard questions. We need answers. And while I do think the conversation had its ups and downs, I want to know what you guys think. How are the answers and what is the take on YieldMax? First of all, thank you for jumping on the channel again. I know you're a busy man, like we discussed. It's always fun having you guys on, talking about what's going on in the markets with your ETFs. And so really appreciate you taking the time to be here.
Yeah, I appreciate you having me. Looking forward to it.
Of course, of course. All right. Starting off, I want to know more about these new Target 25 ETFs, the newer lineup. I think there's 3 out currently. What was the goal behind this new type of ETF that YieldMax is working on?
I think part of the impetus for this came from a couple different things, but the Target 12s, which I personally view to have been a great success, at least from a performance point of view, if not necessarily from an asset attraction point of view. I think that they have illustrated that they have a lot of utility in the market. So, the Target 25s, as the name suggests, are just targeting a 25% annual rate of return, so give or take, call it 2% a month. And, one of the things that we've seen in some of the Target 12s, some of these things they are generating a combination of very nice looking distributions and in some cases, nice capital appreciation as well, right? So I think that there are investors who are interested in that. And I think that's really the reason why we thought those would be a product that would appeal to some people. Because honestly, if we go back 10, 15 years ago and we said, oh, we're going to roll out a product that's going to just make 1% a month distributions, people would have fallen out of their chairs. So they would have just said, that's just, how is that even possible?
Mm-hmm.
And then, nowadays people are so used to selling premium on really high volatility stocks that they become accustomed to this notion that, the distributions are going to be enormous. And there's a balance that ought to be struck depending on an investor's needs and desires, where, you want to balance some capital appreciation and some income if you can achieve it. And I think that's sort of where this falls. We sort of have this barbell on where there's, the Target 12s on one side and very high distribution funds on the other. And so it seems like it might be a happy middle ground.
Definitely. And what was the reasoning behind the selection of the underlying? So we have one on Tesla, one on NVIDIA, and I thought the one on MSTR was an interesting decision. What was the thought process behind that?
So, one of the things I like to say to people about when you have these options-based funds, how the securities get selected, how we select them, in many ways, we're not the ones that select them. The market kind of selects them, right?
Mm-hmm.
So, and how do you make that determination? Well, one of the things is that, of course, we have a variety of products right now, and so we can see where people actually deploy their dollars. There's not much use in creating a fund if nobody invests in it.
Mm-hmm.
The other thing to look at is, of course, where are options actually trading, right? So what stocks have the most active options? NVIDIA and Tesla, for example, are 1 and 2, and not necessarily in that order on any given day. And that's been true now for a couple of years. It's been those two names have been top of the heap in terms of the notional volume that has traded on any given day. As far as strategy is concerned, I mean, that has ranked right up there. It certainly is punching above its weight. So that what do I mean by that? The options volume relative to strategy's market cap is very high. We could actually I'm just going to take a quick peek. We'll see how many options have traded in it today. It'll be interesting to see. So MicroStrategy has traded so far today 250,000 contracts, and that compares with 220,000 on Microsoft. So Microsoft is the 4th largest company in the S&P, and it has traded fewer options contracts than Strategy has. Now, Strategy, granted, is a lower dollar stock price. We'll call it $1.80, so it's slightly less than half. But it gives you some sense of how important Strategy is in particular, I think, to investors. And then, of course, there's another reason, which is that implied volatility plays into this. and the implied volatility of strategy is considerably higher than it is on some other of the top 10 largest companies in the S&P 500. Eli Lilly is the 10th largest, and it is more volatile now than it was a few years ago. I mean, they've got the GLP-1s that obviously is playing into that very heavily. But, volatility matters to investors, and they're more interested in the products that have higher volatility. So I don't think, strategy, in some ways you could say it's a little bit controversial in the sense that it's a smaller company than Tesla and NVIDIA. But in almost every other respect, I think it sort of found its own way to the top more than allowing us to sort of say, oh, yeah, we're going to pick that one. It was certainly not, throwing darts at a board.
Mm-hmm. Interesting. It's nice to look behind and see that reasoning too. It's so interesting. I just thought because of the recent performance, it's been tough. But then you also have MSTY, that's been one of the most popular funds. So it made sense, but just the performance that we've seen with all things tied into MSTR, with Bitcoin, with kind of the pullback, I thought it was just an interesting choice. And a lot of people,
Yeah, I mean, I think that's a great point because, do you launch a product on a stock simply because its performance has been I mean, think about the inverse, right? So let's imagine it was the other way. So we're only going to pick stocks that have been ripping higher of late. Well, what if that suddenly reverses, right? Bitcoin has had a really rough go of it since early October. And Strategies had a really rough go of it since mid-July, actually, because that was really when that multiple spread that Strategy historically enjoyed relative to Bitcoin started to evaporate. And you had a lot of really prominent names coming in and basically taking shots at it. JP Morgan has had some negative things to say about Strategy, saying that it could be pulled out of certain passive indices and so on because of the nature of their business. Jim Chanos was, it's well known that he's short Strategy, long Bitcoin as a pairs trade. And so I think, you have that aspect. You've got other folks who are out there, and it doesn't make sense to bring out every single one of them, but there have been plenty of people who've been critical of it. Do we have a view necessarily on Strategy, bullish or bearish? I have my own views, but as an entity, we have a bullish fund on Strategy. Everybody knows that. It's one of the largest we've got, MSTY, but we have a bearish one too, Winter. And so, we're not necessarily taking sides on these stocks. What we're trying to do is take a look at stocks that have considerable investor interest, have high levels of implied volatility, are likely to be moving around a decent bit. And, as it happens, it also is a good fit for us if we're trading, a lot of options in this stock anyway. I mean, we are a not insignificant portion of the options activity in some of these names. So, we've got traders who are keeping a good close eye on it, and it's well sort of suited for the toolkit we already have in place.
Very interesting. And speaking of that, the popularity, the volatility, I want to jump into our next topic, which is ULTY. So ULTY's had an interesting year, really. I mean, we saw it go from one of the less known, least popular YieldMax ETFs to the strategy change that took place roughly March, April, to a crazy run for a couple months, and then now a drop in price. Can you give a little background into that? I'm curious how that happened. Was there a strategy change by you guys with the options being written, or was it just overall market sentiment with the underlyings?
Well, first of all, I mean, obviously I arrived at YieldMax a little bit after the earlier strategy shift, so I wasn't a part of those conversations. As it happens, I do have the positions that ULTY had at the moment that it hit its peak, and then subsequently where the performance, obviously was not as we might have hoped it would be thereafter, and also what the causes of that were. So let's start with what was in the fund to begin with, and what the fund's mandate is. The fund's mandate was obviously to make high distributions, and it was, basically right on the tin that the objective was to identify stocks that had high implied volatility. In fact, that was sort of top of the screen, right? So you're going to obviously try. This is going to be long the stocks that are in the fund, but the top part of the screening process was volatility, right? That was a big part of it. And if we look at it, in fact, if we want, we can even show folks what was in it at the time. I can share my screen, so let's do that. So we can take a look
Perfect.
what was in this thing. And this is going to be a moment in time. So what I'm going to show here, if you can see this, and I apologize right off the bat because this looks like the Matrix, right?
It does.
Yeah, and you know why it looks like the Matrix? Because it is a matrix.
It is.
This, what you're looking at right here, is something known as a correlation matrix. And if you can see along the left-hand side and along the top, this is everything that ULTY held in it as of October 9th. Why did I choose October 9th? Because October 9th marked, and actually we can look over here. I'm going to just quickly show, from, call it the post-Liberation Day lows. The fund was up close to 44% during this period. So just so everybody knows, that's on a dividend adjusted basis. That's the line in orange. So if we take a look at, and actually it looks like the low was on 421, but so I'm just looking, Liberation Day I think was April 8th if my memory serves. So this is basically how the thing did. The little blue boxes are the distributions that were made along the way, so the weekly distributions that took place. And the white is the price of the security itself. Over here, this is the total returns had you reinvested the dividends. And the number right below that I'm going to circle right here, those are the total returns had you simply just taken the distributions and put them into a money market account, something like that. So 37.5% returns over the course of 6 months. Almost, this is exactly a 6-month period, April 9th to October 9th. So what was in the fund on October 9th? Well, one of the things is certainly that there was some Bitcoin exposure. You can see in here, MicroStrategy. And you're going to notice that the same names appear along the rows and the columns, because this is just, all this is doing pairwise correlation. So you're trying to figure out how much is each stock in the portfolio correlated with every other stock in the portfolio. And the reason you want to do that kind of analysis is because you want to see what the benefits of diversification are, right? So if I bought 20 stocks, but they all behaved exactly the same all the time, I have no diversification benefit. I've just got the same thing divided 20 different ways, right? So what this matrix is showing us right now is the degree to which the names were correlated with one another. You'll notice you see this diagonal right here with all the white in it? All those ones? That's just the correlation of all of these individual stocks with each other, right? So you can see RKLB, RKLB, Palantir, CoreWeave, Hood and Coin, and so on. So that's why that's all ones. Now, it's not important to try to memorize the numbers that are on this matrix. It's just important to bear in mind, look at the colors, okay? So brown basically means there's no correlation. And white basically means there's perfect correlation, right? So you can see that if you ignore everything on the diagonal, in general, there's a lot of brown on this screen. Would you agree?
Yep.
Yeah. Okay. So this is a portfolio that's got, maybe high volatility names, but they're not necessarily correlated names. And that should make some sense, because if you look at this portfolio, you've got names in here that don't necessarily have that much to do with each other. Palantir is in here. Palantir's high beta, high vol, but Palantir isn't Bitcoin. Hims and Hers is a generic drug manufacturer. Again, high volatility, but not necessarily related to the same trade. Well, let's just advance the clock a little bit and see what happened since that time. And so I was looking at the 5 weeks going into October 9th. Now let's just take a look at how these things have behaved since that time. We'll just go to the end of November. Notice any difference? The whole thing turned white pretty much. See that? And I think that is really interesting. I mean, you can see here, for example, look at Palantir versus Robinhood. What does Palantir have to do with Robinhood? Or what does it have to do, with, any one of these other stocks where it turned white? Not a lot, other than the fact that when Bitcoin rolled over in early October, one thing that we did see was a sharp increase in correlation. And that correlation seemed to be hitting high beta stocks. And to a degree, that's not totally bizarre circumstance. When you get into a risk-off situation, correlations do tend to rise, right? Because when people see, oh, wait a minute, I've got things in my portfolio and they're starting to sell off, they get, oftentimes they get very nervous and they'll just say, they'll start selling everything, even if they don't have that much to do with one another. And we kind of saw that happen a little bit in ULTY. And it's one of the reasons why the high volatility sort of risk-on stocks all began to behave a lot more like each other, even if their businesses weren't necessarily related. So if you take a look at ULTY's construction now, Mike Venuto has, hit one of the determinations that he and Jay and other people, and I'm also a part of this, made was they said, look, we should have a non-correlated sleeve. And I want to make a point about this. So non-correlated is not the same thing as anti-correlated. Anti-correlated means if this thing goes up, the other thing goes down. If you get something that's perfectly anti-correlated, if one asset gained 1%, the other would lose 1%. It's not necessarily going to be like that. But you will see things in here that are not likely to behave in any consistent way with high degrees of correlation to other things. What are examples? I mean, you'll notice, for example, that you've got things like Alcoa in here and Southern Copper in here and gold in here and the miners. Those things, is it possible that their correlation can, for a brief period, trend up relative to something else? I suppose it's possible, but they're not heavily correlated with some of these other assets. So there's sort of a non-correlated sleeve. The other thing you're going to observe is that there are some names in here that have elevated implied volatility, but not necessarily super high. So Palantir, which was in there, is still in there. But we've got Broadcom in here now. We have Alphabet. Alphabet is not that's not a very volatile stock. Maybe is it more volatile than Kimberly-Clark or Procter & Gamble? Yes. Is it a volatile stock, though? Yeah, not really volatile. We have some things we can do to try to enhance yield, but the idea is Robinhood, this one is still in there. So some of the names are in common. Coinbase is still in there. But you'll observe also that there are some names in here that are probably not going to exhibit the same kind of conditional correlations that it exhibited previously. And the idea here is just to create some additional stability in the underlying stocks over which we're doing option strategies. And that's the thing, right? So whenever you do option strategies, pick your stocks first, then start selling calls, put spreads, etc. And that's what's going on here. So I think probably it would be reasonable to suggest that the core base of assets that are in the fund now are probably going to have a little bit less of that conditional correlation. And that means that the overall portfolio is not going to be quite as volatile in a risk-off situation. That's our expectation.
Very interesting. Okay, so the goal there would be, that's more of a preservation tactic for the NAV because will we see the yield drop then potentially?
So, the yield is going to float around a little bit as a function of two things, which is the performance of the underlying stocks, as always, and the implied volatility that you're collecting from trading options overlays against those stocks. Would it be reasonable to say that sometimes the distribution could be lower? I think what's going to happen, and part of the mandate is we want to see some increase in the stability of the underpinning NAV, because one of the things that has become very clear is folks don't like reverse splits. So if you have an investment strategy that, because of the way the tax rules work, you have to pay out all of your realized capital gains, your interest, your dividends, all of this kind of stuff, then one of the things you have to do is you have to hopefully have some core bit of holdings that are not going to force you to distribute both up and down market conditions. So is it possible that the distributions could dip at times in order to preserve some NAV stability? I suppose. I don't think we've seen a big dip in distributions so far. I think the thing that's really going to be a driver and that people should focus on is how did the fund do from one week to the next? And how it does is going to be a function of the performance of the underlying stocks and the premium that was collected on those stocks. So assuming that does well, then the distribution should hold up quite nicely. I do think that the intent is to allow those things to float on a performance basis a little bit more than they have in the past. That's my understanding.
Okay. And it brings in an interesting topic because the fan base, I mean, I would go on to say, I've been tracking your guys' funds for over a year now, right? I make videos on the weekly updates. That was kind of the initial real stuff that boosted my content. And we've kind of seen a big shift. And I think part of that definitely has to do with market sentiment and overall return because you guys are, I would say, the name in the high yield space, right? I don't think I ever saw a 100% distribution rate on anything until Coney came around. And so I think that there was a misunderstanding as well with maybe newer investors to the high yield space, misunderstanding that, the difference between a dividend yield and a distribution rate, and the fact that distribution rates at that level, people wanted free money, right? That was the idea where I can get 100% on this annually without realizing the other metrics that are going to determine the overall performance of the funds. So do you think that the YieldMax audience now has shifted away from those super high yield desires and are wanting something that's going to have more stability but still be, 20, 30% yield?
Well, first of all, I don't think you can ever expect investors not to want the really ambitious. They want it all, right? What do
Yes.
investors want? The investors want you to double their money every day if you can, and then they
Mhm.
want you to give that money right back to them also if you can. Whether that's realistic or not, that's a different matter.
Mhm.
Now the issue is that because some of these funds continue to perform exceptionally well, you end up in a situation where I think some people are going to think, well, I get this now take a look at CHPY, right? So CHPY rolled out in early April, and I might as well just share this too. This sometimes you're a victim of your own success, I guess is one way to put it, because what ends up happening is folks think, okay, well, these are the kinds of returns I should get all the time, right? So CHPY. Here we are, early April to the present day. Had you reinvested the dividends, up 64.6%, and if you had just taken the distributions and put them into a money market account, 58%. Well, on the reinvested portion, that is indeed working out to the total returns are over 100% annualized.
Mhm.
And so I think people look at this and they say, well, here, I'm getting it all because in 6 months, I'm up 27% in the stock price. I've taken 30% in distribution. It's up, over 100% on an annualized rate in total return terms. But is it really realistic to think that that's what, we have over 50 funds, that's what all of these funds are going to look like? It depends a lot on the performance of the underlying stocks. If the
Mhm.
underlying stocks are ripping, then good things happen. If they're not doing as well, if you have strategy, for example, and we have like I said, we have a bullish strategy on strategy. We have a bullish strategy on strategy and a bearish strategy on
Mhm.
strategy. And there's no way that both of those things can be up by huge amounts. I mean, the bearish one, actually, what is that one now?
Winter.
Yeah, no,
Yeah.
I know what the ticker is. I'm just saying. So, um, this strategy peaked on July 16th. So it rolled over a lot sooner than Bitcoin did.
Mhm.
And this thing's up 80% since then. All right. So we're looking at a 5 month, less than 5 months. And it's got a 300% annualized total rate of return. Is it realistic for investors to say, oh, well, that's what I should expect in YieldMax funds because that's what this one delivered? Well, no, that's not realistic. And if you look at something like CHPY, CHPY is take a look at the stocks it's in. Is it any surprise that it has done as well as it has when you take a look at this list of stocks? Broadcom, NVIDIA,
NVIDIA. Mhm.
AMD, ASML. I mean, this is basically a basket of the market's winners. And so I guess what I would encourage investors to think about is And this is one of the reasons why I've always been a little bit baffled by why Big E didn't attract more assets, because I think Big E is a very attractive product.
Mm-hmm.
It just doesn't have headline numbers like this, though, because Big
Mm-hmm.
E is, you're investing in the top 50 companies. It's going to behave a lot like the S&P. It's going to pay a 1% distribution, per month. And I guess that's not exciting to people. But, once upon a time that was exciting. I guess
Very, yeah.
It isn't anymore.
Mm-hmm.
So the strategy behind, I'm curious. So what percentage, this is a hard question. When it comes to the returns, is it predominantly determined by the underlying, or is it determined by the strategists that are writing the options on these, attempting to predict, I guess, what market sentiment is and whatnot? Because when we see some drastic changes in just total return, like for ULTY, right? So it started to draw down. We went from 640 to $4 is where it's sitting around, I think, currently. Is that something that we should be not anticipating but weary of when it comes to a fund like CHPY? And how much of that is correlated based off the underlying versus what the strategists are determining for the options?
I think if you're going to invest in a fund that does buy rights on stocks, you got to like those stocks first. So, it's as simple as that, which is one of the reasons why in some cases we have both a bullish and a bearish variant, because there will be people who are bullish on strategy and there will be people who are bearish. There are people who are bullish on Tesla and there are people who are not, and for them there's crash. So you have Tesla and you have crash. So the first thing is, does the underpinning position in equity represent your view? So that's the first part of it. Now, I will offer the following, which is that in general, over time, stocks rise, right? So if you said to me, okay, what do you think Big E's going to do tomorrow? I have no idea because I don't know what the market's going to do tomorrow. But if you said, what do you think Big E's going to do over the next 10 years? I would say, well, Big E is almost certainly going to be higher, probably a lot higher, because it's the top 50 largest companies in the S&P. And the S&P over any 10-year stretch generally goes up. Not a small minority of the time. A big majority of the time. So, I would, and this is something I would also suggest when people look at the bearish ones, for example, whether it's Tesla or whether it is Winter or whatever. I don't think taking a bearish point of view in stocks in general is a healthy way to invest for the long term. Every market has, its duds that end up, not living to play, a decade later. If you go back to 1960s and 70s, there were plenty of stocks that we don't really have anymore. Kodak, Polaroid, film companies. Yeah, well, they didn't meet the transition to digital very effectively. But there are other companies. Lilly was one of the biggest companies in the late 1960s and early 70s, and it still is one of the top 10 constituents of the S&P. And when you look at the market overall, like the S&P 500, what it is a basket of the winners, the ones that are going to keep winning like they have done, and whoever the future winners are going to be that we don't even know who they are yet. So at its core, you want to be long equities. They're just a better, even if you think of them as a store of value, it's better than the dollar, because the value of a dollar has gone down a lot since 1970. And in my lifetime, the value of a dollar has gone down tremendously. I can remember as a kid, my dad taking me to a car dealership. And I remember seeing this car. He was looking at like a used Mercedes station wagon or something like that. I remember looking at the price of this car and thinking, oh my God, that is so expensive. And the car was like $16,000. It's comical when you think about it now. But we had not, we weren't driving around a Mercedes typically, so I didn't know what cars should cost, but I knew that was a lot of money. And then we drove this thing. It was a diesel station wagon. I was thinking, God, it's expensive and it's incredibly slow, because it was making like a huge amount of noise, and my dad had it floored, and I was like, it's not going anywhere. It's like, this isn't very exciting. But I guess my point is that, when you're looking at options overlay strategies, pick a basket of stocks that you like. Presumably they're going to have at least some vol. So I don't get terribly excited about doing buy rates on Procter & Gamble and Kimberly-Clark and Kroger's because in the grand scheme of things, the incremental income that you get from selling options premium on stocks like that doesn't create much of an offset if the stocks decline. It doesn't create a whole lot of distributions on a standstill basis. And in the off chance that, let's say one of these companies got into a merger, but not going to happen to like a Procter & Gamble, but take Kroger's, for example. The thing's trading 10 times earnings. Is it possible somehow that maybe they merge with somebody else and it trades to 15 times? That's a 50% capital appreciation. Do I really want to sell the upside off in something like that? Whereas if I'm looking at a name like, Broadcom or NVIDIA is not expensive as a stock when you think about their future earnings, right? So let's just say, to keep the math easy, let's say it's trading 30 times next year's anticipated adjusted net income, and they're growing at 30 or 40%. Is that expensive? No. But I might be willing to sell off a little bit of the upside in a name like NVIDIA because it also is such a huge portion of the S&P. And at a certain point, the top 10 stocks are 41% of the S&P. Their growth is eventually going to have to converge to GDP growth because otherwise they would swallow the whole economy and many others besides. You just can't, they can't get that much bigger. Again, I think NVIDIA will be the most profitable company in 2026, probably make $180 billion. But I don't mind selling off a little bit of upside when I'm being paid so handsomely for it. If I own a basket of stocks like the rest of these, and then look at, CHPY, for example, you've got ASML in here. There's some really good companies in here, and you get participation. So that's what I would do as an investor, and that's what we do as investors.
Very interesting. Very interesting. I think we have seen a pushback, I would say, from some retail investors. And so I want to jump into some of these viewer questions. They're mixed bags. And I mean, I get it. I understand YieldMax's perspective on some of these pullbacks and whatnot because, we're all investing independently. When people come to me and blame me for investments they made based off a video that I made, I understand that. And you guys have these products. But when it comes to the negative feedback and the reverse splits, I've seen reviews, comments, full videos posted about YieldMax saying that the strategy itself is flawed because without reverse splits, you can't maintain the NAV, right? Because the NAV with ETFs is interesting to me because I was typically a stock investor, dividend-focused investor, and buying and selling has an impact on the price. But for these ETFs, it doesn't, correct?
So, first of all, there's different NAVs to think about. The first is the net asset value of the fund. And what I mean by that is you take $1 million, you invest that $1 million in a bunch of stocks, and then you sell options on those stocks, right? So you have the net asset value of the fund itself. Then you have the net asset value of the shares. So then when you take that fund and you divide it into however many pieces. If I divide it into 1 million pieces, it's $1 a share. If I divide it into 100,000, it's 10, right? The value of the fund isn't going up or down depending on the number of slices that it's been divided into, any more than a pizza grows or shrinks because you've sliced it or you haven't. That doesn't make any difference at all. It doesn't make any difference to the fund managers or the traders because they actually don't have any visibility on this. When the traders are doing their thing, they're not thinking, how many shares is this? They don't even know. So they're just looking at the pool of assets and investing it the best way they know how. So where does the net asset value per share matter? Where it matters is if the dollar price of a share gets very low, it can impact investors because if you wanted to use margin, maybe you can't. Or in some cases, some brokers might say, well, we have a house maintenance requirement for low dollar share prices. And if they get really low, in the case of this is more true for individual stocks than it is for something like an ETF. But if the share prices get very low, exchanges might say we don't want to have these things if they're priced in pennies. So if it's 50 cents a share. Now, the other thing is, does the strategy necessarily mean because you're making big distributions that the share price has to decline? Well, no, it doesn't necessarily. CHPY is an example of this. CHPY has made big distributions. You know, it's distributed 30% or so since April, and the share price is also up 27%. But it's important to understand that when you have a pass-through entity, you may be compelled to make distributions in such a way that you are actually drawing down the net asset value when you do that. I'll give you an example. And this is also goes kind of to that return of capital thing, which some people also talk about from time to time. But in the following example, if I buy shares for $100 and I sell a 2% out of the money call for, call it 1% of the stock price that expires in a week, and the stock goes down, let's say it goes from 100 to 98, and I hand back the premium that we collected on the short call. What happened to the net asset value of the fund over the course of that week? Well, the share price went from 100 to 98, so that's down 2%. And then I handed back the 1% that I got from the call. So now it's the net asset value of the fund is legitimately now 3% lower than it was only 1 week earlier. Now, should I not have given back the premium? We sold the calls for $1 and they went out worthless. So we did collect the buck and we're going to give it back. You still own the stock. The stock's just worth less. Well, so the question is, if you have a circumstance like that where you're always handing back the money and the share price isn't trending in your direction, or at least it's not doing so in anywhere near a consistent enough fashion, the value of the net asset value of the fund could decline. And if you don't adjust the share count, then you're going to end up seeing, a decline in the share price. Now, hopefully, now if you do something like MicroStrategy, or Strategy, bad habit. Strategy's been annihilated as a stock. So if you were in MSTY, not Winter, one of the things is you've been long MicroStrategy strategy as it's been going down. Same thing with Moderna. Moderna has been a complete disaster of a stock. So, what do you want to do with the funds in those cases? You probably want to have a sustainable share price, and you should adjust it and do a reverse split to deal with that. Does that mean that the fund strategy itself is totally broken? Well, no, not necessarily. MSTY did exceptionally well last year when strategy did well. So if the stock isn't going down, if the stocks are going up, then you're not going to have this issue. If the stocks go down, then you might have that issue. So, I think the total returns are the things people should pay most attention to. If you focus on total returns, that's going to give you a sense of, how things are going. And if you take a look at the total returns of, say, like a YMAG, which is just a fund of funds, which has other YieldMax funds in it, or a Biggie, or a CHPY, you can see that the strategy does work. If you actually, here's an interesting one. If on July 16th, you had bought both MSTY and Winter on the same day, how do you think you would have done? So
flat.
Okay. Why would you think that?
One goes up, one goes down.
Right. And the reason you think that is because you're thinking about it in a very linear sense, because you're saying, okay, and I'm going to do this right now. So we're going to put MSTY and we're going to put Winter side by side. Now, remember what I said. Strategy basically hit its peak on July 16th, right? All right. So let's have a peek and see how this actually turned out. I'm going to share my screen right now. This will be interesting. I think you'll find this interesting. This speaks to whether options overwriting can work. So let's look at MSTY first. So MSTY, if you had bought MSTY and just taken the distributions, so you bought it on the worst possible day. And actually, you know what? I should also put strategy itself in here, right? So we can think about it relative to this underlying stock. So we'll compare the stock to the overwrite on the long strategy and the overwrite on the bearish strategy. Okay, so here we go. So strategy down 60%. Stock. See? If you had just taken the distributions, down 46% and down 54% if you had reinvested them. Makes sense because that it would be worse than if you had just taken the distributions because the stock's dropping and every single time you get a distribution, you just buy more of it. And then it keeps going down and you buy more of it. So obviously taking the distributions in cash would have outperformed, but it still did better than strategy itself, right? Because
Mhm.
strategy is down 60%. Well, what about winter? Winter's up 79% if you had reinvested, and it's up 64% if you had taken the distributions. It made more money than strategy lost.
Mhm.
It made more money. And so MSTY lost less than strategy did,
Mhm.
and winter made more than strategy lost. In other words, if you had bought MSTY and you bought winter on the same day, you'd be up money.
Mhm.
So what does that tell us? Is that always going to be true? Does that mean that I should make bullish and bearish bets on everything? Well, no. I'll actually show you one of the reasons that worked is this.
Consistent.
Consistent, exactly. So basically, the bullish strategy was buying the stock, buying, but it was selling calls above the whole way down.
Mhm.
So when you're doing that covered call strategy, you're long the stock, which sucks because the stock itself sucks
Mhm.
during this period, but you're offsetting some of those declines because you're collecting premium. Meanwhile, the bearish strategy is short the stock, but it's collecting premium as well. So it's making this steady decline, but collecting premium. Now, if the stock had done something else, what if the stock had done this the whole time? You probably would not have gotten that dynamic.
Mm.
But the point in all of this is that you can't impugn the strategy if you deploy an overriding strategy that is long and an overriding strategy that is short the stock at the same time, and both net are up money. And it's the same trading team doing these things, right? It's not
Mhm.
like some guy is over there making a different bet. So what this illustrates is that selling options premium can be a good strategy. And it, in this particular case, this is how it happened to work out. So number one, make sure that you are in alignment directionally with the view being expressed in the fund, which if it's a diversified fund should, in my view, generally be bullish. That's not to say that the markets don't pull back. I lived through the tech wreck. I watched the NASDAQ drop 80%. Okay.
Oof.
So that's basically what happened. From March of 2000 over the next couple of years, it rolled over. I was a trader during the great financial crisis. I watched markets get annihilated.
Mhm.
And, obviously we saw that during the pandemic. There are stock market pullbacks, but in general, they go higher.
Mhm.
So as investors, you're better off owning good companies and selling options against them than being short. But
Mhm.
the fact that you can run along in a short strategy and make money by being in both of them illustrates how, selling options premium can work. And, this is a period of time, by the way. What are we looking at here? So let's call it 46% on one side, 64% on the other. That's 18% in 5 months. It's really 9 because you would, if you were going to say I could put $100 into MicroStrategy, it would be worth, call it 40 now. Or I
Mhm.
could put $100 into a long MSTY long winter strategy. That's really $50 each. So,
Mhm.
if I did that, I'd be up 9% in 5 months. I'd say that's pretty good on an
Yeah.
annualized rate of return. And it speaks to the strategy. It speaks to, does it make sense to own assets and sell premium against them? Really what you're doing is you're selling insurance. And the insurance business can be pretty good. But,
Mhm.
if you're selling insurance and, the underpinning asset crashes out, that's generally not going to be a good thing. If you do it on a diversified basket of assets, though, it's probably going to work out fine.
Okay. That makes sense. I didn't realize that winter was that high up. I mean, it makes sense. I am similar to you. I like to go long and up. I'm not really big on the bear plays. But it seems like there might be a disconnect with the big portion of retail investors. I mean, we look at things like the MSTY Mafia, right? These people on Reddit, on YouTube, on TikTok that are diehard fans of MSTY specifically. It almost seems like that isn't. I don't want to say what YieldMax would push because you guys don't push anything in that sense, but that's almost like a dangerous. Would you say that's like a dangerous mentality to have behind any of the YieldMax ETFs? That diehard, fanatic stance.
Well, if you are a diehard MSTY fanatic, that means you are a diehard strategy fanatic, right? Because if you weren't, and all you cared about was selling options on strategy, but you were indifferent to its direction, you probably would have owned Winter and MSTY both in some measure. Funds like, take something like YMAG or YieldMax or Big E or CHPY. Those are semi-diversified. CHPY is not, it's got a lot of sector exposure, but let's just say I like tech stocks and I like overwriting. So you buy CHPY, that's fine. As far as MSTY is concerned, I think a lot of MSTY fanatics are strategy fanatics. I think a lot of people who are buying MSTY are Bitcoin fanatics. And I, by the way, am a Bitcoin bull. I'm on the record as having said it. I said it at the beginning of this year on CNBC as part of the acronym channel challenge. I said it at the beginning of last year. And I said it the year before that. So for 3 years, I've been saying, buy gold, buy Bitcoin. And this year, Bitcoin has not proven to be so great. Doesn't mean that doesn't remain my view. By the way, this is not an investment recommendation for anybody watching. My 2 cents on it, right? So I'm not a Bitcoin salesman. I just happen to believe that the secular dynamics that are in place support it. So if you support Bitcoin, the next question is, do you support strategy? Well, this is an interesting one because there's some very prominent bears out there who have bet against it. Jim Chanos, famously, he's short strategy, long Bitcoin as a pairs trade. And his logic is that strategy should converge to the value of the Bitcoin that they hold. There's a little bit of nuance here because they have 651,000 Bitcoin. At current prices, that's worth about $58.5 billion. And the company itself the market capitalization is less.
Interesting.
But that's not the whole story. So here, this is, as of right now, the market capitalization of Bitcoin is about $52.6 billion. What matters is these 2 numbers as well. So we have preferred stock, which is kind of a hybrid equity debt instrument, and we have debt. Okay? The 2 of these together represent about another $15 billion. Some of this debt is, well, actually, I think all the debt is convertible. So that means that the holders of the debt can convert to the underlying equity. So on a fully diluted basis, someone like Jim Chanos might say, well, that means that the enterprise value, which is the net debt plus the market cap, should be equivalent to the value of their Bitcoin holdings, which I previously said was $58.5 billion. So that's about $9 billion less than the enterprise value is here. But I would say, well, hold on, not so fast. Why? Because a lot of that debt is not convertible at the current stock price. In many cases, the convertible prices, conversion prices, because these guys are basically loaning money to the company with a call option to buy the stock at some higher price. And in some cases, it is a much higher price. So I can actually show you guys, if you care, we'll just take a look at where some of the convertible debt on this is. Some of the strike prices are hundreds of dollars higher. So let's take a look at these ones here. This is a 0 coupon convertible bond that matures in 2029. And the conversion strike on this thing is $672 a share, which effectively means that the benefit of appreciating Bitcoin prices to strategy shareholders is all of theirs to keep. So this is $3 billion worth, all right? So of that $15 billion in debt, $3 billion doesn't convert until the stock is $672, and that's with the stock right now at $183. So that's a huge, huge premium to the current stock price, right? I mean, that's, yeah, it's almost 300% higher. So that effectively means that if you bought shares of strategy and Bitcoin appreciates, is it really 1-for-1 to the Bitcoin underneath? Well, no, not really, because right now there's $58.5 billion worth of Bitcoin and a $53.5 billion market cap. So at least for $3 billion of that appreciation, that goes to the shareholders, not to the debt. And there, as I showed before, there's a bunch of different convertible bond instruments out there, and then also the preferred is also. So you can see that there's 6 convertible bonds in here, and some of these have lower strike prices. So let's pick, I think this one here, these 2030s, I think, if I remember, these are struck like at 430 or something like that. Yeah, my memory is not totally shot. So yeah, 433, that's another 2 billion. So I have now just outlined a third of the outstanding debt in the company that's convertible to the common, but at prices much higher than the stock is now. So what this means is that if Bitcoin took off, let's say Bitcoin doubled from here, went from 90,000, give or take where it is right now, to 180,000. That means that the book value of the Bitcoin held by MicroStrategy goes from 58.5 billion up to 117 billion. But not all of that value is just equally split between the debt and the equity. More of that appreciation goes to the equity holders at first than goes to the debt. Now, at a certain point, of course, all of at least a sleeve of that appreciation goes to the debt, because this is going to be convertible. If MicroStrategy goes to $1,000 on this much of it, this sleeve of debt essentially is entitled to all of that appreciation from 433 to 1,000. On that other 3 billion, they're going to have all of the appreciation from $600 and change. But what this means is that people who buy the equity effectively have a synthetic call spread on Bitcoin. And I think that's the part of it that is not being completely represented. And I understand why it isn't, right? It's you have all of these securities. It's a little bit to dissect. It's not well suited to a soundbite. So it's a whole lot easier just to tie everything up and say, okay, well, I'm going to look at the enterprise value, or I'm going to look at the market capitalization, and I'm, just spell it out like that. But at a simple level, I think basically you're getting it very close. It's very close to 1-to-1 now, book value to equity, in terms of your participation to Bitcoin. And you have a little bit of a kicker in there. So is that leverage worth something to an investor? I think it can be, and it should be. What's the downside? The downside is that there is debt here, and if Bitcoin really rolls over, that debt has to be satisfied. So they are seeing, when you look at a corporate capital structure, debt gets repaid first. And so, equity's at the bottom of the waterfall. And I guess that's arguably the biggest knock. But one other quick point I would make is, let's just take a look at Bitcoin in a long term. I'm going to throw up a log chart here, because I think this is kind of interesting. If you look at a log chart of Bitcoin going way back in time, you're going to see that the drawdown that we've experienced here is pretty small compared to some we've seen in the past. Right?
Yeah.
So let's look over here, for example. Well, how big was this drawdown? Pretty big, right?
Yeah.
80%, 81%. How big was this drawdown? 85%. How big was this drawdown? 84%. How big was this drawdown? 76%. How big is the one that we're in right now? Well, it's pretty small by comparison. So, people who have been in this space for a while, and, I have a good friend, former colleague, long-term Bitcoin bull. He's actually very active on X, Darkside 2030 is what his handle is on X. He was a big investor this whole time. Never sold any. Part of that was because he actually lost access to it for a little while, so he couldn't sell. Leaving that aside, he's witnessed a huge portion of his, net worth, ride this roller coaster over the course of the last, 15 years or so. And he's been in it as long as I've known him. So this is like not some recent participant to this party. So I think if people are used to this kind of a thing, you'd say, okay, well, I can kind of deal with this kind of a drawdown. And I think the MSTY bulls, many of them are cut from that same cloth. They understand this is a volatile asset. They understand that strategy is a volatile stock, and their expectation is that this thing's going to recover. Many of those people bought this thing probably last year, and they were living in the fourth quarter of 2024 when it went up 100%. It's a volatile asset that is it's par for the course. It just comes with the territory.
And so it's a phenomenal explanation to it. And I'm curious what you would say, Mike, to those that call YieldMax as a whole. You guys have been getting some bad feedback, a scam, calling it a way for you guys to make money off the expense ratios rather than, the investors behind these funds. How do you respond to that? Do you think it is just a disconnect between some of the retail investors in the YieldMax space and how these funds actually work? And because I get the same thing on videos as well. And because we've seen some phenomenal performances. I mean, CHPY, I think, was a top 3 weekly dividend ETF in the last 6 months, because I track all of that. I want to know your response. What do you say to those? You can call them haters. You can call them people that just don't believe in it, in YieldMax. How do you bridge that? How do you bring them back into the world of YieldMax without, the people who have said, I'm done, I'm tired of reverse splits? How do you kind of bridge that gap?
Yeah, well, the reverse splits thing, I guess reverse splits took place before I showed up as well. I was a big proponent of doing them this time. Of course, I didn't live through whatever hate came before. It was interesting because when I showed up on the scene, I said, the dollar price on these things has gotten low. We should probably reverse split those. And there was a pretty visceral reaction that I got either from investors I spoke to, and even from people internally who are like, no, never reverse split. I said, what? Why? I said, as a practical matter, there are people who invest in these funds that trade options on them. If you have a $5 fund and you have 50-cent strikes, that means the strikes are 10% of the underlying fund's share price apart. That's not sufficient granularity. That doesn't help investors, and it doesn't hurt an investor if it's $5 or $50. They still own the same amount of underpinning assets. But it does make a difference to their maintenance requirements, to their margin access, and to the options that they can trade on them. So clearly it's better for the share price to be higher. It only costs us time and money to do the reverse split. The shareholders only benefit. So what I didn't understand the pushback. I mean, since I've been around a little bit longer, now that I've actually heard, people have this perception issue, and they're like, well, when companies reverse split, that usually means they're dying. Yeah, except that ULTY had a reverse split, and that thing had actually gone up a lot in value. So that clearly was, they're not, I think they're conflating the reverse split that takes place in a corporation with a reverse split in the fund. Now that, by the way, is not to say that you don't have something that you have to pay attention to, which is the net asset value of the fund itself. What are the total returns? If ULTY had CHPY's performance, right, over the same period of time, would it have reverse split? Well, it wouldn't have, because, if it was, you can see on my screen right now, if you're up 64% in 6 months, or in this case 8 months, you're not going to reverse split because the share price has actually risen by 27%. That's the other side of this, is to say that fund performance does matter, and the fund managers are doing their utmost to deliver that. ULTY's performance since the beginning of October wasn't great because it was in a lot of high beta stocks, and the correlation in those high beta stocks rose as Bitcoin fell. And we went into sort of like I guess it's not that we went into a complete risk off, because complete risk off would suggest that all equities got sold. That's not what happened. What got sold was a lot of high beta stocks. And that's what high volatility, high distribution funds typically invest in. And if you look at ULTY, that's probably the biggest strategic shift that's taken place, is that, Mike Venuto, Jay Pastricelli, Scott Snyder, and the rest of the investment team said, you know what? We want high volatility, and we are going to focus on that. We want high distributions, and we are going to focus on that. But we don't want to have this kind of conditional correlation. This is not, because it's just not helpful to have the underpinning assets exhibit that kind of pairwise conditional correlation. So we're not going to do that. We're going to have a non-correlated sleeve, and we're going to try to stabilize it a bit. And I think that was a good move. I think it's going to pay, if you'll pardon the, given that we pay big distributions, I guess you could say, I'm going to say it pays dividends in the long run. But I do think it's going to create more NAV stability. I think that's something important. And it's, to investors who say, I don't like the fact that the NAV goes down, nobody likes that. Like, let's be very clear. We want everything to look like CHPY. Will it? No, because to do that, you would need to always pick stocks that are climbing steadily at incredible rates like these have, that always have huge implied volatility like these names have. This is the winning sector. Bitcoin was the winning sector last year, right? This is the winning sector this year. I don't know what the winning sector will be next year. Wherever it is, hopefully one of our funds will find it.
Excellent. And what's YieldMax's take that we now have competitors to ULTY coming from some different issuers? And what do you guys think about that? I mean, you are kind of at the forefront of creating a lot of these style of funds. Is there a way to produce? I guess I shouldn't even ask. It's kind of a dumb question. There's no real way to produce a fund that produces 80, 90% with zero NAV erosion. So I know you probably can't speak on competitors and performance and whatnot, but is this something that we being retail investors, need to be weary of when it comes to all of these high volatility assets?
I don't like to, I never like to knock on other people's products. I think that the market, it's a dynamic place. There's a lot of creative, hardworking, and intelligent people who are thinking about different approaches to the market and coming up with different types of products. The only thing I would encourage people to do as they look across the landscape and compare one with another is just make sure you're comparing like with like, which is to say, if you're looking at a fund that buys stocks and sells covered calls against it and makes distributions, that's not the same thing as, say, buying a stock and doing a 1.2, 1.25 total return swap on the underlying equity and making distributions. One is basically employing leverage and giving you a return of a portion of the upside when you get it. And the other is selling options premium. So they have very different return characteristics. I will say some of these, some of them seem to be performing, I think, maybe they haven't been doing great because the underpinning assets have been going down. So in the same way that I say, look, if you buy MSTY and strategy goes down, that's the performance of the underlying stock. You could have bought Winter, which obviously appreciated. I'm not going to criticize somebody else's product because the underlying stock went down. I instead would actually take a look at how their fund has done relative to the underlying stock and whether it did what it said it would do in that circumstance. From what I can tell, many of them are performing kind of as you would expect them to in those circumstances. Bearing in mind that a lot of those products are on a lot of the same underlying stocks, and they choose them for the same reasons that our exchange traded products have been chosen, which is that's where investor demand is. That's where people are trading. So unsurprisingly, they've chosen the same things, like whether it's MicroStrategy or NVIDIA or whatever. I think that it is a healthy thing, and for the market to come up with these new products. I just say make sure that you know what you're getting, because if it's a levered product, leverage works great on the way up. Tends not to work as great on the way down. And as you can see, MSTY outperformed strategy on the way down. It's been horrible. It's been a horrible ride because strategy's gone down 60%. But it did better than strategy did because you're collecting those options premiums. If I was in a 2x levered position, it would have been obviously worse.
Yes.
So, that's the important thing I would keep in mind. The other thing I would say is if you look at all of the funds we've launched on the long side, so every long covered call ETF plus the sector long ones plus the biggies and the chippies and everything else, the total returns in the aggregate for all of these funds has stacked up very favorably to other long equity investments one would have made. And I think that speaks to the strategy. We've got, like I said, over 50 funds. And if you look at the performance of the whole gamut of these things, since the
Mhm.
day they were launched to the present day, they have done very well, I think, relative to other funds, relative to the market, and
Mhm.
other strategies. And I think that speaks to the strategy that we're employing.
Mhm.
Hopefully the underpinning assets do well. I think there's one other thing that tends to happen, and that is that this is true in stocks. It's true in futures. It doesn't really matter. Investors, and even, I've been a trader since the 90s, we tend to gravitate towards where the action is.
Mhm.
And how do we learn about that? Oh, this thing doubled, or whatever's really moving. That's
Mhm.
like moths to a flame. We tend to be drawn to it as investors, as traders. That's where we go. And oftentimes we do so with blinders on. And when we do that, we're ignoring a lot of other good opportunities. In a universe where we have a lot of funds, I'm not surprised that everybody gravitated towards MSTY after strategy had the year that it did last year.
Mhm.
But very often, the things we ought to be investing in are not what won last year, but what's going to be hot now. And if you look at ULTY and the shares that are in it, and you'll see that there are periodic rotations, it's real-time transparency, that will give you a sense of what the portfolio managers who are running it now, what they think the next hot thing will be. Whether they'll be right or wrong, time will tell.
Mhm.
But I mean, if you look at what's in there, this is, you can ask yourself, are these the types of names that I want to be in?
Mhm.
Um, I think there's some really interesting stuff in here, and there's some non-correlated things as well. I mean, gold obviously is a hot trade. It's been a hot trade all year.
Mhm.
Copper, which is in here now, you can see that Southern Copper is in here. The gold-copper ratio, copper's about as cheap as it has been relative to gold in my professional life, and then some. Maybe in my whole life. I don't know that copper's ever been cheaper relative to gold than it is right now. So I think that's kind of an interesting place to be.
Mhm.
Alphabet, this got added November 13th or 14th. I remember I happened to mention it on Fast Money around the same time. Obviously, the stock's done fabulously well since then. Some things we
Mhm.
didn't know ahead of time. We didn't know that it was going to be announced that Berkshire Hathaway bought 17.9 million shares of it. That got announced right after we bought it. So that was a win.
Mhm.
Lucky for us. But that wasn't the reason we bought it. It was in anticipation that Berkshire Hathaway was also acquiring it. The
Mhm.
shares were purchased because the stock was cheap. The shares were purchased because it's growing faster than the S&P 500 revenues and earnings are.
Mhm.
Exposed to all of the things that we care about in the marketplace, they've got YouTube, which is obviously huge on the content side. They're in cloud. They're in AI. They have all of these great core businesses. And, and it has good, decent volatility. So, it was in there for the right reasons, and it happened to work out.
Mhm.
I feel much the same way about Amazon. Am I, NVIDIA was in here. It isn't anymore. Do I feel bad about that? No, even though I think NVIDIA is reasonably priced relative to growth, because we already have so much exposure to the space. How
Mhm.
much more do you need? If you've got Broadcom in here, you've got Amazon, um, you have all of the AI exposure that you need, I think, in this, and then some other diversified things as well. So, I like the way this is shaping up, to be honest, in terms of the
Mhm.
portfolio construction. If you were going to throw a dart at a board and say, you land on one of these to own, how do you feel about it? Is there anything that sticks out as definitely not in there? Probably not. I don't know. What do you think?
I thought your take on copper is really interesting because I've never been big into commodities. I've never owned gold or silver. I do now. We talked about this last time. I had you and Mike on where we talked about. I had a professor, finance professor, that said, "Don't bother. They're going to underperform long term." And you guys were like, "Whoa!" And yeah, that cost me some money for sure. No, I mean, looking at it, it seems it's really interesting. So the change up with ULTY specifically. So what percentage of these are super high implied volatility in comparison to how it used to be structured?
Well, I think I think everything in it was super high volatility before,
Yeah.
right? So if we go back to, we can go to this thing that I was showing you before, And we can just take a look at these names. So this was October 9th. Everything in here is high vol. Very high. Now, some of these names are in common. Hood, Palantir is in here. Hood's in here. So those are clearly, we still have that, right? But it's not all the same. So, Broadcom is reasonably high vol. Palantir is definitely high vol. Bitcoin is high vol. Hood is reasonably high vol, I think it would be safe to say. NewScale, this is certainly a high vol name. SoFi, Twilio, Micron, reasonably high volatility names. Gold is not super high vol. It's been higher vol lately. The miners are a slightly levered play, and this should make some sense to us, right? Because the way to think about a gold miner is if you just like you do with an integrated oil company. An integrated oil company is, at the end of the day, basically the discounted value of their reserves, right? So you're buying the oil they have in the ground, but how much the company is worth is going to be a function of the value of the oil relative to the operating cost to extract, refine, distribute, sell. Similarly, it's true for miners. So if the price of gold is going up faster than the expense to mine it, they're going to be levered to the upside, and indeed they are. In fact, it was a long-term sort of rule of thumb that investors would use, that GDX would trade at about 2x the upside to gold. That actually broke for a little while, but that has subsequently, we've sort of returned to that level of outperformance. So it's going to have slightly high, you get still the exposure to gold, but you get a little bit more volatility out of it. So you have that. HCA Healthcare, it's a hospital operator. That's, not super high vol. So I think it's striking a decent balance, which, by the way, is what we hope the fund does too, that it strikes a decent balance between harvesting something from the options market and having a core pool of assets, because that's essentially the collateral that you're using to sell options premium. You want to have some stability to that. I mean, you could take a look at something like NewScale. Let's say you're an individual investor and you were thinking about this, and let's say that's the only idea you had. NewScale is also, big shares of that company are owned by Fluor, which is the procurement, engineering, and construction company. They have a big interest in this business. You could buy that and have lower volatility of the core underpinning asset, because the rest of the company, in Fluor's case, is trading around 15 times earnings, but you're going to get lower options premiums out of it. And in this particular instance, you don't really need to, because it's diversified. Your entire exposure to NewScale is 3.3% of the fund. Right. So it's pretty well diversified, and NewScale really doesn't have that much to do with Alphabet, doesn't really have that much to do with HCA Healthcare. I guess the closest tie-in between something like a NewScale and the hyperscalers is that one of the reasons people believe in companies like NewScale, which makes small modular reactors, is that they believe that, small modular reactors are going to play into the infrastructure and power needs to support the new economy and all the data centers. That's part of the logic. I mean, this is still a pre-revenue company. But this is, I think, kind of the logic in all of this. And, he's not on this call, but if he was, I'm sure he'd tell you he's pretty happy with it. Mike Venuto, I know he's happy with the constituents of this fund. There's nothing I look at in here and say, I'm not a fan of that. I understand why these things are in here. And if somebody else looks at this and they say, you know what, I like these stocks, I'm into it. Morgan Stanley is an interesting one too, because Morgan Stanley, the reason I think this is interesting is, as a financial, how this differs from, say, a Goldman Sachs. Goldman Sachs has a lot more investment banking. Morgan Stanley, they used to be almost like exact competitors with one another. They're not quite as much anymore, because Morgan Stanley is more on the asset management side. They made several years ago, they made a big push, and they said, okay, we're going to focus more on asset management. Nice thing about asset management is that, their fees go up with assets, and their assets grow just with the market. So they're not dependent on trading profits. And, Goldman Sachs is pretty good at generating trading profits. Let's be honest. They don't have that many losing days, but they're not as dependent on investment banking. So it's a slightly different business. I think it's a good business. I think that pivot was an important one for them, and they've done very well with it.
Very good information. Yeah, I like the breakdown. It'll be really interesting to see how ULTY performs kind of moving forward. I'm really curious. And so I do have one final thing to discuss, Mike. I just wanted to give you an opportunity. We're gonna have a mix of people watching this interview. There's gonna be YieldMax haters, YieldMax lovers, and everything probably in between. I wanted to give you an opportunity to not necessarily pitch, but speak directly to the YieldMax haters, the people who say who have either never invested in the fund or have invested and lost money, lost big money, that are currently out. Do you have anything to say to that portion of the audience?
I mean, first of all, to any investor in anything that has lost money, whether it's a lot or a little, I'm sorry that happened to you. I will say that I think that all of us as investors, it behooves us to sort of stick to sort of a core first principles of investing, and that is, number one, invest in things that you believe in. If you don't believe in YieldMax, there's two parts of the YieldMax story that you would need to believe in before you would. And what are those? The first is that there is a process by which the underpinning stocks are selected that makes some sense. And in the case of ULTY, what are those? We're looking for stocks that have momentum. We're looking for stocks that have a decent fundamental story. And when I say fundamental story, we're looking for things like revenue growth, earnings growth consistent over time. Things that would be warning signs are, because we won't, it's not like we see everything. Sometimes we have to absorb what the market's giving us. But if we start seeing analysts having negative quarterly revenue revisions, if we start to see growth rates slow, if we start to see margins compress, those are all worrisome. If we see something drop below a long-term trend line, that is something that is a warning sign to us that even no matter what we've looked at, maybe there's something that we're missing here. And these are priorities that are going to inform how the stocks in here get selected. So that's the first part. Do you believe in the underpinning stock selections in these funds? The second is, do you believe in selling options premium against stocks as a way to generate some returns? If you don't believe in that, then it's going to be hard for you to go along with the things we do. There's plenty of evidence, not just ours, but people can do their own work. In fact, I encourage them to. There is plenty of evidence that there is a persistent volatility risk premium. We are in the business of selling insurance on stocks. And the insurance business can be a good business at times. Sometimes it can be a painful one. But in the long run, it tends to generate returns. That's what we do. And if you believe in that, then the only final part to do is to see how well we're executing it. And that can be determined by taking a look at what's in here. It's not a mystery what's going on in ULTY, because every single day, the stocks that are in this fund and the options that are being sold against those stocks is going to be shown. So you can see it for yourself. Maybe you think you can do it better. Maybe you believe in those stocks and maybe you believe in that strategy, but you don't believe in the traders. And you think you could do it yourself. It would be a lot to manage. I think Scott Snyder and Jay Petrocelli and the team, a lot of these people have the same background that I did, which is that they are former options market makers. In some cases, they were floor-based guys, as I was first, who then later became dealers upstairs. There's a lot of experience in there. So those are the things you have to believe in: the stocks, the strategy, and the people executing it. And if you don't believe in those things, then I could understand why you wouldn't be interested in YieldMax. If you do, then the other part is just understanding how these types of strategies behave. And then I think you're going to probably be more comfortable when, not just when things are going well. Everybody's comfortable when things are going well. But you're going to be more comfortable when things aren't going as well, believing that the right process is going to get you ultimately where you're trying to go.
Excellent. Well, I want to say thank you again, Mike, for coming on, giving us some phenomenal explanations and some of the insights into YieldMax, the ETFs as a structure and as a whole. It's been great having you on.
Well, I really appreciate your time. Thanks.